I want you guys to pause the video right now, go grab a pen and a pad or open up a Google Docs because we're going to be dropping a lot of great information in today's video. Over the past couple of years, we've talked a lot about how to get access to financing, right? Whether that's credit cards, loans, lines of credit, personal, business, SBA, CDFI, whatever the case is. So getting access to funding is actually fairly easy. We've helped thousands of subscribers and clients get access to tens of millions, if not hundreds of millions of dollars over the past 5 years. Getting access to capital is fairly easy if you have the right strategy, if you understand the data points, and if you structure your profile in your paperwork to be able to match the underwriting criteria. So that's actually really easy. But you know what the hard part actually is? What are you doing with the money once you get it? This is something that is often overlooked because a lot of people want to get access to funding. Oh, I want to start a business, or I want to go do Turo, I want to go do real estate, but haven't really thought about exactly what they're going to do with the money. But where the real value comes from is utilizing business financing, because with business financing, you're able to scale, you're able to make money off of that credit. You're actually able to leverage that credit to make a lot of money. So that's what we're going to be talking about in today's video, but specifically proven business models. All right. So one of the questions I get all the time is, what business should I start? And honestly, I think if you don't have business experience, it's going to be harder for you to start a brand from scratch. Now, the best way to start, in my opinion, is getting down with a winning team, getting in with a proven concept. Now, this could take several different forms. For example, let's say before you even start a business, what you want to do is secure your home base, what I consider home base. So this could actually be your job, right? So if you have a 9-to-5, make sure that's stabilized before you try to start a business or invest in a business, because with businesses, usually when you're starting them, it has to be stabilized first. And sometimes there's several weeks, months, or even sometimes years before you're able to prove a concept, stabilize a business to where it's generating revenue and it's profitable for you. But if you're just starting from scratch, what I would suggest, and again, this is just my opinion, this is not financial advice, is to get in with a proven business model, and franchises is actually one of the best ways. So in today's video, we're going to be talking about franchise financing, and a lot of people don't understand it's actually a lot easier to get financing for a franchise because it has a proven business model. And the other hack that I'm going to talk about is how you can get approved for franchise financing with projected financials, right? So let's say an established business, right? For example, you've been in business for 2 to 3 years. If you go to a bank and you want, for example, an SBA loan or a business line of credit, they're going to want to see 2 years of tax returns in most cases. You go to Truist Bank, Bank of America, PNC, a lot of these major banks, they're going to want at least 2 years of business financials, profit and loss statements. However, let's say you have a 9-to-5 career and you're looking to perhaps purchase a franchise, whether that's a Dunkin' Donuts or Jersey Mike's or Smoothie King or some type of established brand. It's easier to get financing that way versus if you started your own business from scratch and then you try to go get an SBA loan, because you would have had to prove your own concept, generate revenue in tax documents. Whereas let's say someone who has a 9-to-5 right now, maybe you got a little bit of money saved up to put into a franchise business, you can get funded right off the bat without needing established business financials, because you can leverage the projected financials from an established brand to get financing. And this actually comes from what's called a franchise disclosure document. I'm going to go over that in a second, but we're going to cover some of the top lenders in the franchise lending space. All right. So the first one we're going to go over is called BoeFly. Guys, write this down. So we've actually helped a handful of clients get franchise finance. I've actually gone through this process personally, so I could personally attest to these different financial resources when it comes to franchise financing. And BoeFly is, I would say, one of the premier companies that work with franchise. Now, BoeFly actually, what they do is they do verification. So like asset verification. So before you're able to open up a franchise, one of the first steps is asset verification. So you have to have a certain amount of liquid capital, and you also have to have net worth requirements. So BoeFly is really tech enabled to where you could connect accounts. They're actually enabled with Plaid. Let's say if you're using real estate for your net worth requirement, they do all the back end research to basically qualify you, because some franchises, they might require that you have a certain net worth threshold. Let's say 250,000 plus 100,000 in liquid funds, right? So there's certain requirements based off of each franchise. And if, let's say, you want multiple units, you're going to be a multi-unit franchise owner, then you have to have even more. So they basically are doing the verification, but they also have a parent organization, a parent bank that offers financing as well, which we'll go over that. You can go on their website, and they actually tell you the types of brands that they work with. So you can see right here, one example is like a Jamba Juice. Let me see if I could show you guys just a list of the different franchises. This guy right here, he was actually on a Say Cheese interview. He owns multiple Smoothie Kings. I'll pin the interview down in the description, but just to zoom in a little bit of some of the different brands, they work with dozens and dozens of brands, but like Smoothie King, Bojangles, Buffalo Wild Wings, Jimmy John's, Tent World, Myco, Bright Star Care, among others. That's not all of them. They work with a ton of them. Essentially what they do, they'll walk you through the entire process, help you put together financials and your initial business plan and things like that, basically giving you everything that would be expected to be able to qualify to get a loan from a bank or from the SBA to be able to open up your franchise. So they do the soft pull. They basically do asset verification, background checks, and they offer full financing support, not just with their in-house lender, which is their parent company, which I'll go over in just a second, but they also have what's called their verification tool, BoeFly. So it basically reduces like the workload. Think of BoeFly, let's say, so y'all know about with Clutch, they have a lot of these back-end APIs where they verify information on behalf of different banks. BoeFly is doing this on behalf of different franchisors. So instead of the franchisor going out and trying to verify all your information, they basically do it on their behalf. So BoeFly, through their BoeFly verification tool, is doing a lot of the due diligence on candidates and vetting them. So if you're able to get through their processes, that's a good sign. So again, a lot of franchises do work with them. I'm not going to get too deep into this, but they do, like I said, liquidity and net worth verification and credit and criminal background checks. A lot of brands will have you go through BoeFly before you actually do, for example, your discovery day. Discovery day is when you go to their corporate headquarters and they walk you through everything. But just to give you a quick background on BoeFly, BoeFly was actually bought out by a bank called Connect One Bancorp. Now that's the parent company, I guess you can say, of BoeFly, but two separate entities, right? Connect One is a bank, whereas BoeFly is, like I mentioned, they do asset verification and all the due diligence on candidates on behalf of different franchisors and different franchise brands. So again, this was from several years ago, but they were acquired by Connect One Bank, and Connect One Bank is an actual bank that offers different term loans, revolving lines of credit, personal credit as well. So when I refer to their in-house financing, BoeFly is not just a verification, credit check, background check. They also have their in-house financing as well. As far as the programs that they offer, BoeFly, so they have partner lenders. They have another really unique way to finance a franchise business is through what's called a ROBS 401k rollover. So basically, if you have an old job that has 401k funds, let's say in a retirement account, you can roll that over, and then there's a method of doing that to where you're not subject to a taxable event, right? So then you can, I'm not going to explain the process maybe for a separate video, how the ROBS rollover 401k works, where you're able to, let's say you have 100,000 in an old 401k that's with Vanguard or one of these management companies. You could actually take that money, and it's not a withdrawal and you're not borrowing against it. You literally can get access to the funds through a rollover, right? So real quick, and not to get too off topic, but the way the ROBS works is you roll it over from a 401k to an IRA, and then that IRA is then rolled into another 401k plan that is set up through a C corporation. There's companies that will help you, like Benetrends, for example. They'll do everything for you, where they set up the C corporation, they set up the 401k plan under the C corporation. Once the funds are rolled over into that 401k plan, the 401k plan buys membership interest of the C corp, and then the money is then deposited into the corporate checking account of the C corp. Then you can get that money and use to open up a franchise or whatever the case is. I've actually gone through that process. So they also have 7A loans, 50 to 5 million, usually 10-year notes, right? And then, as I mentioned, they also have their in-house financing, right? Now, the other benefit, like I said, with franchises, and this is why I really like franchises, right? Because again, most of the time when you're trying to get a business loan, let's say me, for example, I have a business that's been in existence for, let's say, 6 years, right? A little over 6 years. For me to go get a SBA loan or any type of business line of credit, I got to show them tax returns from previous years, right? And in order to be able to show them tax returns and financials, that means I would have had to have prior sales, prior revenue, prior activity, right? And mind you, it took several years to build up to the point where, okay, I can qualify for certain types of products, right? But let's say someone, again, is coming from a 9-to-5 job. Obviously, they're not going to have a business set up that has financials. It would be much easier for someone coming from, let's say, transitioning from a 9-to-5 or no prior business experience to get a franchise loan to open up a Dunkin' Donuts or a Smoothie King or whatever the case is, just based off of the projected financials of that franchise business. And the way they're able to use it is through what's called the franchise disclosure document. So for those who don't know what a franchise disclosure document, FDD, so every year the franchisor collects data from all the franchisees within their brand. And so they create this report. This is usually like a 100-page plus report, which outlines every nuance, all the information about that particular franchise brand. But what they also have in that is the gross sales numbers, and they break it down. Let me actually give you an example. Now, I'm not going to tell you which brands these actually represent, but I just wanted to give you an example. So let me zoom in a little bit so you can see. So this is an FDD. So I'm not going to share which brand this is, but this is just for illustrative purposes. But they'll have something like this where they'll show the average net sales. Prior to you making an investment decision in a franchise, you could actually see what their sales look like, and it has it by the top 10%, top 25%, top 50%. So just looking at these numbers, right, when you look at the average net sales, and again, net sales across all the franchises, $661,000. Y'all see right here, $661,000. That's average net. So you take all the sales and divide it by the total number of franchises. That'll give you the average net sales. Then you have the median net sales, right? So the median would be 50% higher, 50% lower, right? So that's at the midpoint if you're looking at a distribution of all the franchises within that brand. And then they have these other ones for the top 10% and top 20%. So like, again, let's just take this for example. So this franchise brand has 970 franchises. So 243, which would represent the top 25%, had average net sales of $959,794. The top 10%, which represents 97 of them, and let me just explain how that works. There's 970 franchises. So the top 10% would be the top 97. So the top 97 of the 970 had average net sales of $1.1 million, median net sales of $1 million, and then the range of sales, right? So when looking at the top 97 of the 970, the top 10%, at the lowest range, right? So let's say you only looking at the top 10%, the range of the lowest, right? So one way to look at this, the minimum net sales to qualify for the top 10% is $948,902. And the highest grossing franchise had net sales of $1.658 million. So maybe let's just say 1.65 million. So this information you can use, or you'll be able to receive prior to investing, right? So you could use all of this as part of your due diligence, right? And again, this is just net sales. So just giving you an example. So when you look at the FDD, will look something like this. All right. Within the FDD, you have financial performance representation. So that's where you'll find all the information I just went over as far as the net sales, mean, median, top 25, top 50, whatever the case is. And then they also give you like the bottom 50, right? The bottom 50, when you're looking at this, or one way to look at this, right? So this is the franchise that did the worst. So when you're looking at the bottom 10%, so these are the lowest grossing net sales. The lowest was 195,681. And the top of the bottom 10% was 411,706. Apple Pie Capital is another top tier franchise financer. So basically with Apple Pie Capital, they work exclusively with franchises. So you can't apply for a regular loan. So usually what I recommend, you could get pre-approved, but usually what happens, the order of operations is that you would reach out to a franchise brand and essentially, have some conversations with them. And what they'll do is they'll have you get pre-approved through their preferred lenders before moving forward, right? Because they basically want to make sure that you're financially qualified before, again, during the discovery day. There's also what's called validation when you talk to existing franchise owners to get more insight, ask them questions, like an interview. But anyways, with Apple Pie Capital, this is another specialty franchise financing company. They've been around for quite some time, and I believe they're backed by Cross River Bank, so that they have a sponsor bank on the back end, but they're exclusively for franchises. So you can get pre-approved through their website. All they do is franchise financing. They provide over $3 billion in loans to franchises, and they work with 100+ franchise brands. It's super important to be working with one of their approved franchise brands, because the thing about it is that the FDD is part of the underwriting. So the reason why you can leverage the financials of these existing franchise brands is because there's already a track record in a history, and they have data points from hundreds, if not thousands of other franchises. So they're already familiar with the business model. They're already familiar with their sales and expenses and development costs and things like that. So instead of you having to prove a concept out and prove the numbers to them, they already have hundreds of different franchises, data and information, gross sales, net sales that they can use as far as the underwriting process. So that's why I was saying this is a great way to get in, because you don't have to reinvent the wheel. The wheel's already reinvented for you, and the data's already there. That's another thing. So just some examples of the approved brands with Apple Pie Capital. You got a Jimmy John's, a Jersey Mike's, Little Caesar. You got Fast Signs, Scooters Coffee, Orange Theory, Anytime Fitness, Goldfish Swim School, Massage Envy, Supercuts. Now, if you're trying to get for a franchise that's not one of their trusted brands, it'll be much more difficult, right? Because if they're not familiar with the business model, if they're not familiar with the franchisor, there's just not as much information for them to go by. So just keep that in mind. But if you're going through any of like their trusted brands that they're constantly underwriting deals for, then it's way easier because they have more information. And what you'll do, you can start your financing inquiry. You'll just type in, let's just say, I'm just going to use Smoothie King as an example. The list will show up. If it's populated here, it'll tell you, just click on it and hit next. And it says, great news, Apple Pie partners with Smoothie King to make financing easy. Now, you can go through the pre-approval process, or you could schedule a call with them first. Now, I would suggest before you even jump out there, is actually have a discussion with one of their representatives, because that'll give you more insight as far as what to expect, what the qualifications are, and so forth. So if you're able to just have that initial conversation, I could tell you with a lot of these, whether that's BoeFly or whether that's Apple Pie Capital, or let's say if you go the SBA route, you could begin with as little as 10% down. So let's say if it's $500,000 to open up a location, you could probably get in with I would say this, expect at least 20, but you can get as low as 10%. And again, it's going to depend on different factors, your net worth, profitability of the franchise, the average gross sales, your credit score, your assets, things like that. Apple Pie Capital. And again, they are sponsored by Cross River Bank. So I'm just going to put Cross River Bank. So basically what happens is they get these warehouse facilities and they could relend the money essentially. And then what they do, they'll sell these loans or put them in like a secondary market type of marketplace like Loan Street, where, you know, credit unions and big banks will buy the loans once they're performing. So that's just a little side note. Now going back, all right, so we went over IRH Capital. Here's some contact information right here. I'll zoom in. If anyone's interested, you could reach out to their specialist. And they have different specialists that are assigned to like different brands. This is just like a starting point. So Macrolease is another, again, specialty financing company, but their parent company is Brookline Bank. Now let's go real quick over what they offer. All right, so they offer equipment financing from $75,000 up to $300K per facility. They also have development lines of credit up to $5 million for multi-units. Now, here's a little side note I wanted to just let y'all know about, right? And I'll just put that here. So once you have a stabilized franchise unit, it's way easier to get financing for additional units, right? So you can leverage or even cross collateralize an existing stabilized franchise to open more. So you could leverage a stabilized franchise unit to open additional units. All right. So once you get that first one, all right, once you secure home base, it's way easier to get your second, third, fourth, fifth, because you've already have a proven concept, right? And I'll go over this in just a second. Acquisition financing, buying or selling the store. Upon franchisee executing term sheet, approval rendered within 3 to 5 days. They also have refresh financing, 75K plus application only. So right down here it says, for a franchisee who already has one or more stores, we require the above items plus latest year-end business tax and current interim on existing stores. If non-related businesses providing a guarantee, this information would be provided on that entity. So pretty much, let's say you wanted to open up multiple locations. You can use the financials in the history from the stabilized unit to open up more and actually to be the guarantor for the additional units. So that right there is a game changer. So all you really need is to get your foot in the door with your first location. After that, there's so many different ways that you can leverage. All right. You also have IRH Capital. All right, so let's just write that down real quick. IRH Capital. Pretty much they offer similar products as far as what they do: acquisitions, remodels, working capital, new builds for new and existing franchises. They have a streamlined funding and approval, application only up to 300K, conventional term out to 7 years, and SBA up to 10 years. And up to 100% financing. Now, one thing I will say about franchise financing, the SBA loans are really what's being pushed right now. And for new franchisees, that's probably going to be your only option. Now, they do have bank term loans, but from what I've seen, just with helping a lot of clients, the SBA loan just seems to be the best fit. You have up to 10 years, 10-year notes. And then the other thing about the SBA loans is that they're not like a fixed rate, right? So basically what happens is, let's say the Fed funds rate goes down or the bank lending rate goes down, they'll adjust it the next quarter. So that's the one thing. It's like a variable term loan, if that's even a concept, but that's just one way to think about it. Whereas most loans are going to be fixed. With these loans, it's actually not fixed. It's fixed up until the point where the Fed funds rate or the bank lending rate changes. So that's just one thing to keep in mind. So just a recap, you got BoeFly, which again does asset verification, income verification, soft credit check, background check, things like that. So they vet you before you're able to move forward in the sort of due diligence process, right? Before you're able to go to your discovery day and do your validation, they got to verify that you're even financially capable to be able to open up a location. And then they also have their parent bank, which also offer their in-house financing, right? Apple Pie Capital, a specialty lender specifically when it comes to franchises. You also have Macrolease and IRH Capital. Now, there's more than just these, but for the sake of this video, I just wanted to focus on some of these. These are some of the bigger players in the space as far as franchise financing. And again, you also have SBA, but all of these institutions also are able to administer SBA as well as their in-house lending as well. So that's just one thing to keep in mind. But the key takeaway with this is that instead of, and again, this is not financial advice, but a lot of people want to jump out into business. They want to get funding, but don't know what to do with the funding. And basically what I'm advocating for is plug in with a proven business model, because a proven business model is more likely to have success because there's systems in place. You could also leverage the brand name recognition. All right. So if you want to bring, let's say, a franchise to a new market, that franchise may already have brand name recognition. So you don't have to establish who you are, because more than likely people will already be somewhat familiar with it. You also have the support of the franchise system. So as far as marketing, for example, a lot of times as part of the fees that you have to kick up to the franchisor, you might have a marketing fee where you put a certain amount of your gross revenue and it goes into a marketing fee, which pays for ads, promotions, things like that. You have systems in place. So there's like standardization. And then as far as just the support, one thing that the franchisor wants to make sure is quality control. So whatever products or services that you're offering is going to be consistent across the brand. So you get a lot more support when you have a franchise versus when you're trying to create your own business and develop these systems on the fly. It's more or less plug and play. Now, the other aspect of it is, I guess the overlooked one is not really the financing, the down payment, right? I would say more of the people management skills, right? Because as a franchise owner, you're going to be hiring, you're going to be firing, you're going to be figuring out schedules. More likely, you might have to put managers in place. And who knows, you might even need a sweat equity partner to actually help and support you if you decide to expand, or if you want to be, let's say, more of an absentee type of owner. So it's much more involved than just having the down payment to get the things off the ground. But the thing I like about it is that you're plugging into a proven concept. There's usually going to be standard operating procedures, training available. For someone who's just starting out, I think it's something to consider. Now, I'm not saying you're going to get super wealthy by doing it, but what I will say is this could actually set you up for generational wealth, because as I was saying earlier, what you want to do first is secure home base. Now, for me, I'll just use myself as an example. For me, my first home base was my corporate 9-to-5, right? That was able to pay the bills. That was able to allow me to feel comfortable taking a risk as far as business, right? So then once I started my business, and again, I didn't start off with a franchise. I started off with creating my own brand and building that over several years and letting that breathe, and then taking some of the money that I made from that and plugging that into other things such as franchises, such as real estate, other limited partnerships and things like that. This could actually set you up to go even further. Because again, like I was saying, let's say looking at some of these numbers, let me go back, where was this at? Okay. Now, mind you, these are top line numbers, right? Top line numbers. All right. Let's just look at median. Let's just look at median, right? You got 633,000 gross sales. Let's say one location nets you $100,000 a year profit. All right. Now, does that mean you're going to get super wealthy off of that one location in 1 year? Not necessarily, but that, let's say that 100,000 net profit that you're making every single year, that could provide you the stability to then maybe do something else later down the road, knowing that, okay, I have this proven business model that's cash flowing. And if I'm an absentee, it may not be tugging into much of my time and resources. Once you get it stabilized, you put a manager in place, you have employees, stuff like that. And then that might just cover investments that I could continue to reinvest. So think about every year you're throwing another 100,000 into investments, and it's just, you have this cash flowing business is just spitting off cash, right? Maybe you taking a salary out of the business in addition to, the profits at the end of the year. And then the other thing I was saying is we know the power of data and information. So if you have a business with tax returns, financials, revenue, sales, that in itself can unlock additional opportunities. Like I was saying, you can use the financials of one of your locations to open up a second and third location. And then let's say later down the road, you want to get out of the game, right? Let's say you own 3 locations now and all the loans have been paid off. So there's no debt on the companies, and you can sell those at a multiple, right? Based off of, again, maybe what the revenue is, what the net profit is. There's different ratios that are used as far as business acquisitions, but you can cash out at the end and, have a bigger windfall. So there's a lot of different ways that you could look at this, but I just wanted to introduce you guys to this. And I think this will be a great way going forward over the next couple of years. There's this whole thing about baby boomers passing up businesses and then certain businesses closing down. So that opens up the opportunity for new businesses. So I think there's a lot of opportunity with this. And again, you don't need to be super well off or anything like that. I would say if you're able to inject anywhere from $75,000 to $100,000, you can get in with a lot of these franchises. Looking at some of them, again, you should expect or anticipate to have at least 20% of your own funds to put in to all the development costs, franchise fees, and everything like that. However, you can pay as little as 10%, depending on the scenario. Again, I would say don't expect to put down 10, expect to put down at least 20. But if you're able to get 10, that's even better, right? And then the other thing with a lot of these lenders, not only is it the development cost, but also you're going to need working capital, right? So a lot of these loan financing packages also include working capital. And the other thing about it, the way a lot of these loans work, for example, with BoeFly, let's just say, if you go through the pre-approval process, so you get pre-approved before you sign your franchise agreement, it's going to be months before you actually are drawing on those funds. But the great thing about it is that once you're approved, once you sign your franchise agreement, that money is allocated. So then the next step would be securing your location. So it works almost like a construction loan where you got to prove months in advance and sometimes maybe a year prior to actually breaking ground and putting shovel to dirt. But that money's allocated, so you don't have to worry about the financing after that point because the financing has already been secured, which is a great thing because then that gives you just that peace of mind to know, okay, you're able to fully finance the construction costs and you're going to have some working capital if you need it once you're up and off the ground. So I just wanted to share this with you. Just to recap, we went over BoeFly, Apple Pie Capital, Macrolease, IRH Capital. And the key takeaways, the key benefits, I just want to reiterate with this, right? Plugging into proven business models, because I see this all the time where people I want to start this business and then wind up failing because there's no systems in place, they don't have experience, they don't have support, and wind up getting into more debt. So proven business models, proof of concept, that's the most important thing with business. With franchises, you're able to leverage their name brand recognition, their marketing, the support from corporate. So there's a lot of benefits plugging into proven business models. Think of it almost like having a coach in a system versus just going out there playing with no playbook, so to speak. Projected financials, this one right here is a game changer. So instead of you going out and creating financials, generating sales, expenses, tax returns, and then going to the bank to get a loan, you don't need that when you're going through franchise financing because the underwriter is going to use the projected financials, which are provided by the franchisor. So the franchisor is able to provide the projected financials, and they have information based off of the franchise disclosure document, which has historical sales information, and usually they're using the most recent year of the FD. So this is recent sales information from perhaps hundreds, maybe and sometimes thousands of existing franchise stores. So that's a lot of information. So they don't necessarily need to know exactly what your store might do because they have the information on hundreds of others. So they have the data points to be able to underwrite with confidence. And again, like an Apple Pie Capital, they're familiar with a lot of their partnered franchisors because they're doing deals all the time. So they're familiar with their business models. So this is the thing that you could really leverage as someone who doesn't have business experience. Maybe you're transitioning from the 9 to 5. Maybe you do have a business, but maybe your business is not as successful. You could basically come in, and if you have certain net worth requirements, a certain credit score, and a certain amount of liquidity, you can get qualified to purchase a new franchise location. And the last game changer I wanted to just lay out there is leveraging a stabilized franchise to open additional franchise units. So once you get one off the ground, like I said, you secure that home base. In this case, you would be securing second base. You're securing second base once you're able to stabilize the first location and then use that to secure a second and third location. All right, so that's when, once you get that second, third, fourth, fifth location, that's when you hit a grand slam and you're off to the races. You're building your wealth. And so this is something that is much more challenging to do and probably not even possible just with existing businesses, right? Because you're just going based off of your one unique specific business. But when you get into the franchise world, there's so many ways to leverage. Like you're leveraging the data of existing businesses to get funding to then open up an additional one, perhaps in a new market. So definitely take advantage of this. I know that was somewhat long-winded, but if anyone is interested in learning more, this is a lot of information that I have as far as lenders. And if anyone has any questions or needs some introductions, I could definitely assist with that. And just wanted to put this out there. Again, not financial advice, but anyone interested, I've dropped some links in the description of the video. That's all for today. Until next time, take it easy, and we'll talk to you soon.